What's up, everybody? Welcome back to Trades and Gains. I'm your host, Max Pitts, and this is, as always, powered by Investor Central Club. So let's go ahead and pull out your rectal thermometer and do a temperature check. If you looked at the headlines this weekend, you'd think tech is imploding, AI is officially a bubble, gold is collapsing, the Fed, well, it's about to get rebooted, and everyone suddenly cares who Kevin Warsh is. But if you looked at the indexes, nothing really happened. That's the theme of this market right now. A whole lot of motion with very little progress. And that's very dangerous water to tread in, because when markets stop moving up, they start punishing confidence or hubris. This week is packed. We have jobs data. We have Alphabet and Amazon earnings. We have a fallout from the Warsh nomination, commodity volatility, in a market that's quietly admitting it's basically one macro trade wearing different outfits right now. It's a cross-dresser. So today, we're not doing hype because, let's be honest, we don't do hype on this channel. Hype is how you get burned. Hype is how you end up in one of those other crappy discords. We're doing what actually matters this week, and how not to get chopped to death trading it. So yes, there may be some days where we just hang out on stream all day and watch the horrible price action that is going to ensue. All right, boys? So just keep that in mind. And that's over at Free Wi-Fi Radio, our live stream channel where we stream the market from market open to market close. We make live trades and we bank as a community. So here's last week summarized for everybody. Everyone sold something different for the same reason. Tech sold off, gold and silver got absolutely nuked, the dollar ripped, oil spiked, and indexes, well, they were flatter than your girlfriend. That tells you this isn't panic, it's positioning stress. And the reason? Well, everyone's leaning the same way. Let's talk about Kevin Warsh first, because Wall Street suddenly discovered his Wikipedia page. Markets were told for months, Powell's out, something big is coming. Then Warsh gets nominated and stocks barely react. Now why? Because Warsh isn't a wild card. He's not a Volcker, he's not a Dove, he's not going to save risk assets with QE confetti. He's structurally conservative, skeptical of balance sheet heroics, and allergic to inflation optics. Translation, a Warsh Fed right now is not a cut first, ask questions later Fed. And that matters because the market is still priced like cuts will fix everything, even though they've just made things worse time and time again. The only person that it's made it better for is IWM, because those poors down there and that Russell 2000 index can't afford these high rates. Am I right? And that matters because, yeah, like it needs to stop just being IWM is the only one that benefits from rate cuts. That assumption is getting even shakier by the day. Now, let's talk about the metals massacre. Gold, it's down 9% in a day. Silver and platinum were down 20 to 30% on Friday, right? That's not risk off. That's crowded trade unwind. Gold wasn't hedging inflation anymore. It was hedging AI uncertainty and Fed panic. Once Warsh shows up and the dollar rips, that hedge fund gets pulled. Now, this matters because gold, crypto, AI equities are all increasingly the same macro trade. When one cracks, correlation shows up fast. That's your warning sign for this week. This is the most important line in the entire video, by the way. Diversification is increasingly masking a single macro bet on AI. Again, I'll say that. Diversification is increasingly masking a single macro bet on AI. That's dead on. Right now, tech portfolios, credit portfolios, commodity exposure, and even productivity narratives all trace back to AI spending continuing forever. But there's a problem. AI went from a self-funded capex cycle to a financing event. Debt markets are noticing, equity markets are even noticing. Microsoft already showed what happens when spending scares people. And let's take a look at that, by the way. Let's take a real look. Look at this. So this was Microsoft's earnings. So as we can see, yeah, not pretty. Not pretty whatsoever. It's like getting catfished. So, this week, Alphabet and Amazon matter way more than they usually would. Not because of revenue, but because of how they talk about CapEx and return on investment. Now, everyone keeps asking, are earnings good? That's not the right question. The real question here are earnings concentrated? Meta beat and ripped ass. Microsoft beat and sold off. That tells you everything you need to know. Guess what? I've been saying it for years. The conference call matters more. The conference call will always matter more, okay? Now, this is what the markets are allergic to currently. Spending without clarity, growth without margins, and CapEx without payoff times. Alphabet and Amazon don't need to blow out their numbers by any means. They just need to avoid saying something dumb. But then again, it's the tech cycle, so that there's a high chance that they might just say something dumb anyways. So be prepared for that. That's all I'm saying, folks, okay? Because here's the reality. Most of these companies right now, their earnings are priced to perfection. All right, so just keep that in mind while we're looking at earnings. Most of these companies, Palantir, Amazon, Google, they're going to be priced in for perfection. I will also have some more earnings reports done today and published over on my Substack. Now let's go ahead and talk about the one thing that none of you have, jobs. Get it? Because like the job market is crap right now. Anyways, the consensus, we're expecting plus 65,000 payrolls, unemployment steady at 4.4%. Now, here's the irony. A soft jobs print, it's bullish at the end of the day because a soft jobs print gives the Fed some fuel to reignite rate cuts because they want to, quote unquote, save the labor market, right? And a strong jobs print is bearish because, well, if strong jobs are in the economy, then it doesn't give the Fed any type of inclination to cut rates anytime soon because people are still getting jobs, which means they're getting paid so they can afford to, you know, spend their bi-weekly paycheck on groceries and rent and never do anything fun with their family, right? Now, again, why? Well, strong jobs reports, like I said, they delay cuts. They support the Warsh-style hawkish patience, strengthen the dollar, and they pressure valuations. The Fed isn't cutting because growth is fine. They're cutting because they're scared of over-tightening. This week, the market wants weak but not broken. So most likely, they'll want it to come in between, I would say, like 50 to 62,000. And even then, if we hit 62,000, we'd probably get a nasty chop. Anything else is going to go ahead and create volatility. And then we're going to sit in those days where we see SPY sell off and then completely recover, you know, kind of like this day. Yeah, this is what we call a non-committal print for macro print, right? So next topic we have to cover, class, is oil. Oil is quietly up 7% in a week, and nobody's panicking yet. But if energy stays elevated while jobs stay okay, growth stays positive, inflation stays sticky, that's how you end up with fewer cuts, higher real rates, and tighter financial conditions. And that feeds directly into tech valuation pressure, metals unwinds, and credit stress. This is the macro feedback loop that nobody's currently pricing in. Do you see how all of this kind of relates? How people are like, well, why are we seeing this happen? And then I tell everybody why it happened. They're like, well, that doesn't make sense. Well, it's because we're in an endless feedback loop. It's like being on the Truman Show, you know? Everybody's watching you without really watching you. So, and let's talk about some of our key earnings and macroeconomic deals. So, on Monday, we're going to get on the economic data front, SMB Global Manufacturing, PMI January final reading, which was previously 51.9, ISM Manufacturing, January 48.3 expected. We have Palantir, Walt Disney, and a bunch of others, but those are the main two. On Tuesday, we're going to get JOLTS. We'll get JOLTS quit levels, job openings, layoffs, and then Ward's total vehicle sales. And on the earnings front, we're looking at AMD, MRK, Merck, Pepsi. What else do we have? Pfizer. Man, we got a big day on Tuesday, boys. Electronic Arts, PayPal, SMCI. Then on Wednesday, we're going to look at MBA mortgage applications, ADP employment change, S&P Global U.S. Services PMI, and ISM Services Index. On the earnings front, we have Google, Lilly, Novartis, Novo Nordisk, Mitsubishi, QCOM, Boston Scientific, and those are really the only ones I'm kind of seeing. Again, I'm doing a quick skim of all this. On Thursday, Challenger job cuts year on year. Initial jobless claims week ended January 31st, and continuing claims. All right. On the earnings front, we're looking at Amazon, Shell, Sony, ConocoPhillips, where else? Roblox, Cummins, because I'm coming, Blue Owl Capital, and Affirm. Friday, we're going to see change in non-farm payrolls, unemployment rate, average hourly earnings. Again, all that macro data. And then on the earnings front, we're looking at Toyota, Philip Morris, and that's pretty much it. So how do you actually approach this week? Here's the Trades and Gains view. AI leaders, well, still leadership, but not the only ones showing ROI. Mega cap earnings, guidance over EPS. But again, if you've been following me for a while, you know that is pretty much the church and hill that I die on. But that's also because I used to work in tech and used to do forecasting. So what do you think? Commodity or jobs data, volatility catalyst, it's not direction, FYI. This is not, the jobs reports this week are not going to show us a direction. It's just a catalyst for more volatility in the market. Commodities, well, they're crowded. Trades are fragile right now. The dollar strength matters more than people think. This is a market where you sell it strength into crowded narratives. You buy dips only in proven cash flow names, and you size like the tape can flip on one sentence. One market, one trade, and right now, everyone's on the same side. That's usually when things get interesting. Anyways, this has been Trades and Gains. I'm your host, Max Pitts. Use the code SUPERMAX20 for 20% off your first month. And make sure you comment, like, subscribe, and leave your hottest take down below, because I want to hear from the people, because I'm a man of the people, for the people, by the people. Anyways, I hope you guys have a great Sunday, and be on the lookout for some earnings reports from me. I will see you guys in the next episode.